and 22%. And the big mistakes I see a lot of YouTubers make is that they overestimate what companies can do in a very short window, and they're building a biased story. With us, we want to be unbiased. Welcome back in, everybody. So today we're going to do something a little bit different here. We're actually going to dive into a stock that just hit a 52-week low. I'm going to talk through some things, how I come up with my valuations. I've seen some crazy things out on YouTube, and there's YouTubers that have a tremendous following that I've seen kind of put out ridiculous valuations. So I'm going to take you guys through my process, and I always recommend dollar cost averaging into a well-diversified index because it is a lot of work following individual stocks. So if you don't have the time and effort to put in, just dollar cost average into a low cost, well-diversified index, and you'll be just fine. Now, the company we're going to talk about today is SBUX. That $7 Frappuccino, Alpuccino, Cappuccino, whatever chino you want, Starbucks has it to offer, and they definitely know what they're doing because they've grown rapidly. And so as it hits a new 52-week low, is this stock a buy? And we're going to touch on not just fundamentals and coming up with a price target, we're also going to touch on a little bit of technicals, and I'm going to show you why that is. Now, when we do a quick scan, there's two stocks on here that really get my attention. Number one is going to be UNH, and number two is going to be SBUX. Both companies are hitting 52-week lows, which could be an opportunity, but I want you to pump the brakes a little bit here. There is reasons why it's a 52-week low, and when you're buying at 52-week lows, just remember the momentum is definitely against you, which means it could get uglier. So that's why we lean on the technicals just to understand how ugly it could get. So when we pull up a chart of SBUX, it is definitely a vision of beauty here. It has done nothing but go up in a straight line. And the nice thing is it's responded extremely well to the 200-day moving average, where it bounces off of this moving average and uses it as almost like support. And now here we are today, and it's broken below this moving average down here, which to me is kind of a red flag. Not only do we have a break above the moving average, but there is definitely a clear head and shoulders pattern formulating here. And when we get tops in markets or we get tops in stocks, these are definitely technicals we want to pay attention to because they tend to play out a high percentage of the time. Whether that is a reverse head and shoulders finding a bottom in a stock, meaning that this formation would be flipped upside down and basically pointing down this way and heading up the opposite direction instead of pointing down the way SBUX is pointing. But this is a good way to signal a top, a bottom. And so right now, it definitely looks like SBUX is in some interesting territory here, but how bad could it get? Let's bring it down to a 2-year chart. So when we bring it down to a 2-year chart, there's something definitely formulating here where SBUX is getting lower highs and lower lows. Lower high here, lower low here, lower high here, lower low here, lower high there, and then now here we are with a lower low. This is definitely a bearish formation, and it's broken behind, and it's broken down under a long-term moving average. Two bearish signals. We'll push out the chart just a little bit further to kind of find where this could go. So I'm seeing a clear formation here where SBUX has hit this numerous times, and it's been a great line of support and or resistance for the company. We've seen it multiple times hit this line, break above it, break back down, and it really respects this trend line here. So we're going to draw this trend line and just keep an eye at where it's at. It's basically between $76 to $79. So somewhere in this range is where I think SBUX might find some support, currently trading at $84 a share. So keep that on your back burner as we go through the fundamentals now. Now, over the last year, SBUX is down 20%, and as I stated earlier, it is an ugly chart. Clear downtrend formulating, breaking down below major moving averages, multiple reasons why this is a bearish chart. And when we line up the story, I think you'll see why that is. So when we look at sentiment around the stock, which I like to do sometimes, we can see a price target anywhere as high as $150 and as low as $90. Currently, SBUX is trading at $84. And I do think it could get somewhere into the mid 70s. Now we're going to get in the nitty gritty of what this channel is all about, and that's usually fundamental analysis. So when I look at the fundamentals of SBUX, first thing I want to point out is just tremendous top line growth. This is a company that really consistently grows between 5 to 15%, which is following nice through operating income and very good EPS growth as well. But what we know about EPS growth is stock price usually follows EPS growth. Now, free cash flow has kind of been all over the place, but dealing with a commodity like coffee, I think this is something we can understand. And for people that invest in dividend growers, this is definitely going to be on most people's radar as it hits a 52-week low, because this is a company that consistently grows their dividend. Here's what I want to point out is operating income is actually coming down, not expanding. And so that to me is definitely something I'm keeping an eye on. Same thing with EBITDA margins, but they're consistently staying in the 20s. Yes, they'll have these dips, but they usually recover back. We can see EBITDA margins as high as 29% and as low as 18%. Now, I already started kind of building out my DCF model for them, but I'm going to use EBITDA margins of 20, 21%. So we want to try to be as open-minded as possible. There's some good things we're seeing with this company. There's some bad things we're seeing with this company. The good things are the revenue growth has been there. The bad things are there's some inconsistencies because we're dealing with commodities with pricing and margins. So we have to understand that there is some liability with owning a company like this, that there could be some heavy swings on margins and free cash flow. Now, currently Starbucks is paying a 2.69% dividend, has a PE ratio sitting right around 23 times and a forward PE sitting right around 20 times, basically trading at a market multiple, which to me, you have to justify very good growth rates if you're going to be paying a market multiple for a company like Starbucks. So the question now is going to be coming down to what kind of growth rates can we project out for a company like Starbucks? Now, before we do that, I do like to kind of just breeze through their return on invested capital. Return on invested capital sitting at 27%, which is extremely strong. So they're doing a good job deploying capital. Total cash on the balance sheet and cash equivalents is sitting at $3.3 billion, while total debt is sitting at almost $25 billion. So that is a pretty substantial amount of debt for the company. This is a company that can free cash flow between, call it $4 to $5 billion. They free cash flowed $4.5 billion, so they can definitely handle the debt load that they have. I don't think it's anything alarming, but I would say that it's not a perfect balance sheet. I would like to see a little bit less debt, maybe just a little bit more cash, but overall, I would say it's a pretty decent balance sheet here. So when we start comparing their valuation to their peers, Starbucks is definitely trading at a premium, and rightfully so. From a gap standpoint, they're basically trading at a forward PE sitting at 20 to 21 times, while industry standard is 15 to 16 times, and price to free cash flow sitting at 14 times. For a company that's growing, for a company that's still growing, I think this is appropriate. If it's a more mature company, I like to see it 12 and below. But for a company like Starbucks that still has a tremendous amount of growth still possibly left in it, then I think this is a good valuation for the company just by looking at it. So we're gonna take a look at what analysts think growth rates can be for Starbucks. We're gonna look at two different websites. I think 5 to 10% is about what I would be thinking just now. Yahoo has them growing nearly 16% over the next 5 years. That to me is pretty high. I'm not sure if they can do that. I definitely feel closer. I definitely feel better coming down. Possibly a little bit around 9 to 10% would be the highest that I personally would want to go. But we'll see what Stock Analysis thinks for growth rates as well. So I think Stock Analysis is a little bit more on my page here, where 9 to 10% growth rates I think is going to be realistic here. So let's start plugging in some numbers. I want to give a fair warning here. This is not a company that I've done a tremendous amount of digging into. This is me just scratching the surface to see if this is a company that is in a buy zone for me. So from a technical analysis, I do think it needs to possibly get down into the 70s, but we're going to get the fundamental analysis here. And if the fundamental analysis is screaming a buy, then I definitely think it could be an add to the portfolio. So for growth rates, we're going to use 9. We're using 9, 7, and 4% growth rates. I think that's realistic for the company to achieve. I think they can overachieve that. So if we get anywhere close to a buy on this company, then, it's a pretty easy buy because we're not putting anything we're not putting anything outrageous out there that they can't achieve. I think 9% growth rates, 7% growth rates, and 4% growth rates over the next 10 years is pretty realistic, considering that a lot of analysts are projecting out 10 to 15% growth rates. So we're definitely undershooting and building some safety in there. Now, the biggest question we're going to have to figure out is what kind of multiple do we want to put on a company like Starbucks? Currently trading at 16 times EV to EBITDA versus industry standard of 10 to 11 times enterprise value to EBITDA. So I think using a 15 multiple makes a tremendous amount of sense here. And take a look at this, ladies and gentlemen. Giving ourselves a 10% rate of return, we get right around a $72 price target from a multiple of EBITDA and a $62 price target for Starbucks. So where I think how I would approach this would be, I definitely would be interested in the stock if it gets into the 70s, probably start slowly averaging in. But the majority of my money, I'd be looking to add in the 60s, $65 to $60 ideally. But I definitely would reach a little bit on this because I do think they can outpace the growth rates that I projected out there, which means that there could be which means there could be more price discovery ahead for this company. At the same time, I don't want to commit too much capital if I think it could reach these prices, and I definitely think there's an opportunity for it to get back down into the 60s or low 70s. So I'm going to give my price target on StarBUX between $68 to $75. Hopefully everybody enjoyed my dive into StarBUX, and as always guys, really appreciate your time, and we will see you in the next one.